Do you know what is LBO model and how to prepare that? This is the very common question in the financial model or the investment banking interviews. So let me discuss about this, what is LBO model and how to define that. An LBO model is something like the financial tool that typically built in the Excel to evaluate the leveraged buyout transactions, which is the acquisition of the company that is funding using the significant amount of the debt. Both the assets of the company being acquired or those of acquiring the company are used as a collateral for the financing. The buyer typically wishes to invest in the small possible amount of equity and fund the balance amount of purchase price of the debt or the other non-equity sources. The aim of the LBO model is to enable the investors to properly assess the transactions and earn the highest possible risk-adjusted internal rate of return. We call it as a IRR for the another model. So in the LBO model, the goal of the investing company or the buyer is to make the high returns on the equity investment using the debt to increase the potential return. The acquiring firm determine if an investor is worth pursuing by calculating the expected rate of return and whether the minimum is typically considered 30% or above. The IRR rate may be sometimes to as low as 20% for the larger deals when the company or the economy is unfavorable. After the acquisition, the debt to equity ratio is usually greater than 1 to 2x. Since the debt constitutes the 59% of the share price, the company's cash flow is used to pay the outstanding debt. There is a structure of LBO model. In the leveraged buyout, the investor form a new entity they use to acquire the target company, and after a buyout, the target becomes a subsidiary of the new company, or two entities merge to form a one company. Capital structure is something like that. It's a capital structure in LBO model. It's a refers to a component of financing that used in purchasing a target company. Although each LBO is structured differently, the capital structure is usually similar in most new purchase companies, with the largest percentage of LBO financing the debt. The typically capital structure is financing with the cheapest and less risky, first followed by the other available options. First one is a bank debt. That is very common source for the debt, so we can take this as a senior debt. It is the cheapest financial instrument used to acquire a target company in the leveraged buyout, acquiring the 50% to 80% of LBO's capital structure. It has a lower interest rate and the financing instruments and making it most preferable by the investors. However, the bank debt comes with the covenants and the limitations that restrict a company from paying the dividend to the shareholders and raising the additional bank debts, acquiring the other companies while the debt is active, and bank debt typically comes with a payback time of the 5 to 10 years. If the company liquidates before that, the debt is fully paid and the bank debt should be paid first. Next one is a high yield or the subordinate debt. So this is something like that. It's an unsecured debt that carries a high rate of interest and compensate to the investor for risk in their money. They have their less restrictive limitations that there are the bank debts. In the event of the liquidation, high yield debt is paid before the equity shareholders, but after the bank debt. The debt can be raised in the public debt market and institutional markets. Its payback period is typically 8 to 10 years with a bullet repayment and the early repayment options. The another one is mechanized debt. So it's a small or the mid layer in the LBO capital structure that is hybrid debt or the equity or a junior or subordinate to the other debt options. It is often financed by the hedge funds or the private equity investors or come with a high interest rate that the bank debt and the high yield debt. Mechanized debt, the form of the high yield debt with the option to purchase a stock at a specified price in the future as a way of boosting the investors' returns and with the risk involved. It allows the early payment options and the bullet payments just like a high yield debt amount. So during the liquidation, mechanized debt is paid after the equity or the other debts have been settled, but before the equity shareholders are paid. Next one is equity. It's comprised of 20 to 30% of LBO financing, depend on the deal. It represents the private equity fund's capital and attract a high rate of interest due to the risk involved. In case of the liquidation, the equity shareholders are paid last. After all the debt has been settled, if the company defaults on the payment, the equity shareholder may not receive any returns on their investment. So this is a typically LBO model works. In the next video, we are going to discuss about the typical LBO model by the practical way in the Excel file. Let's meet in the next video and stay tuned and subscribe to our channel for the more content regarding the investment banking and VCs and PE in the startup fundraising. So let's meet in the next video. Stay tuned and like the videos.